Okay, sir. You can start.
Let me just post the. I will just post the today's link.
And meantime, sir, actually, I am building a small strategy on how to calculate the value so that where to put the investment and how to check that. From this learning, I'm just making one scheme, and I want to discuss with you. May not be not now, maybe after the exam or after the term. For that, I need your means email ID to communicate so that I can send you. You can put your word. You need to look into this part also.
Sure, sure. Like the one thing you can do is you can drop me a direct message on our Google discussion form on this course ID. There in our like the one-to-one conversation, I will share my personal email ID and we can have a like chat.
Oh, in the Google, yeah, I can do the direct messaging there.
Yes, I think I received some of them in the previous term.
Since nobody is here now, you can just give your email ID here. I will copy it and
It is
send
being
the.
live streamed, so we will do that later. Okay.
Okay.
Yeah, sure. So, hi everyone. Welcome to our course on corporate finance, and today we will be discussing the portfolio theory, which we covered in our week 7 and week 8 content. So that is our primary focus of today's session. So we will go step by step, and I will also demonstrate the Rise Business Schools platform, and we will do the visualization over that. And at the end of the session, I will be doing like how we can create efficient frontiers in Excel also when we have like the share prices available to us. How can we build our efficient frontiers and how can we draw the capital allocation line? If time permits, we will do that also. So the first case in our portfolio theory is like the if you are an investor and you have only two assets available to you, one is risky asset and one is risk free asset. So risk-free asset is the one which has no variation, which has a sure short return. So risk-free asset is with RF rate of return and sigma F is zero for risk-free asset, and risky asset it has RP as return and sigma P as standard deviation of the return. Okay. Now you want to derive like what is your optimal like the according to your preferences how much you should invest in risky asset and how much you should invest in risk free asset. Okay, so let's suppose you invest w% of your wealth in the risky asset and remaining in the risk free asset. So and you build your portfolio which we call the combined portfolio, or that we denote that with subscript C. So for that portfolio the expected return will be W times the risky assets expected return plus 1 minus W times risk free assets return. Correct? And that is simplified in this form. Now, what will be the variance of this combined portfolio? So there is no variance coming from the risk-free asset. Only variation coming is from the risky asset. So that is equal to like the variance of risky asset is sigma square p. So for the combined portfolio, it will be W square sigma square p, and we can simplify it to sigma is equal to W sigma p. Okay, now we can combine both of them, and like we did in week 7's live session also, like we derive which we call the budget constraint also in the case of portfolio theory. And in that in that case, like it comes out to be in this form, like your expected return of your portfolio is as a function of portfolio variance, portfolio standard deviation. That what we want, because we will be doing our visualization in mean and standard deviation form. Mean and standard, where like my horizontal axis is standard deviation of the portfolio's return, and vertical axis is return of the portfolio, expected return of the portfolio. Okay, now we can derive it, and that comes out to be in this form, like the ERC is equal to risk free rate of return plus sigma C, that is the combined portfolio's standard deviation, sigma P is the risky asset standard deviation, times ERP minus RF. Because W is, if you look closely, we have just replaced this W by sigma C by sigma P, correct? And this is the budget constraint in like the mean and standard deviation axis. Now, what we do, we derive a special ratio which we call the Sharpe ratio, and this is a measure of like the how much reward you are getting against your volatility. So let's suppose if a asset has some amount of volatility, then how much reward you are getting again in order to be at that volatility. That is this Sharpe ratio measure, and this is a very important measure, and it defines a particular assets, like how worthy a particular asset is for the investment. Okay, so Sharpe ratio is nothing but like the difference between the assets expected return and the risk-free rate divided by assets standard deviation, that we call the Sharpe ratio. And this budget constraint which we derived in our last class, if we simplify that and if we look closely, then the slope of that budget constraint is nothing but the Sharpe ratio. And if we write it in this form, then we call it capital allocation line. So this is like when we have one risk-free asset and one risky asset, then a line combining them gives us all the possible allocation points which are available to the investor. So that's why we call this capital allocation line. We can allocate our capital in any ratio, like the like we can give any weight, and if we change these weights, then also we will be on that line only. That's why that is called capital allocation line. Okay. Okay, let's have a look at our that like the visualization tool which is developed by Rice Business School. So if we go to the home page, so let me start there only. So this is the home page of this learn investment at the rate Rice Business.
Can you share that link?
Yeah, the link is there at the end of this, like this live sessions. Like if you click on this learn investments at the Rice Business, this is a hyperlink. If you click on that, it will open this platform, and there if you see, there are like multiple options available to you. So there are like time value of money, risk and return, portfolio, CAPM. So you can, like, the topics which we have covered are time value of money, risk and return, portfolios, and capital asset pricing model, that we will be covering in later later weeks. Okay, and today we are covering this portfolios. Okay, and right now we are focusing on risk free asset. Let us go there and let's see, yeah, what it gives. Okay, so it is saying like there is one risk free asset and one is risky asset. This risky asset is this one, which has standard deviation of 30% and return of 10%, and risk free rate is 2%. Correct? Risk free rate is nothing but the savings rate. Okay, and yeah, this is like standard deviation of risky asset is 30%, expected return of risky asset is 10%. If this is the situation, Then line combining risk-free asset and risky asset, that is called the capital allocation line. Now, but it like there is a possibility that you go to the market, like you are an individual who wants to take more risk, you want to invest more in, like more than 100% of your wealth in the risky asset. Then what you would do, you would go to the market, borrow some money, and then invest. So you are investing more than 100% of your wealth in risky asset. Okay, so you are borrowing. So if the risk free rate and the if the risk free rate and the borrowing rate, like the saving rate or the borrowing rate, are the same, then this is the capital allocation line which we will be having, like it will be a straight line. But usually we know in real life that is not the case. Like there is always borrowing rate is higher than the savings rate, correct? So let's suppose if it's little bit higher, if like the savings rate is 2% and borrowing rate is 3%, in that case you will see like this dashed line is the line which is according to the borrowing rate. Okay, so if you see like the this dark blue line, so it is there is a little bit of kink when you start borrowing in the market. Suppose if you want to invest more than 100% in the risky asset, then you have to go to the market and then invest that amount into that. And in that case you will be facing a different rate of return, that is the borrowing rate. And you will see like the higher the difference between the risk free rate and the savings, like the savings rate and borrowing rate, this kink will be like the much steeper. So is this clear to you? Like this is what I am trying to show here. Like if like the if borrowing rate is higher, correct, like this is the case. Like the in the right side of this orange dot, that is the risky asset. All the points on this line in the right side of that, that is the case where you are borrowing, or in other words you are sorting on the risk free asset and investing that amount in the risky asset. So so when you have only two options available to you, then this is the this line which we call the capital allocation line, that defines all your investment options. Okay, now once you have this capital allocation line available to you, now you can look at your preferences, which are defined by your indifference curves. And in the last live session we seen, like in this expected return and standard deviation plane, your preferences are upward sloping indifference curves. And let's have a look at them also in our this Rise Business Schools platform. So here, if you like, we are looking at risk free asset. Now I want to look at preferences. So I will go to this drop down menu and there you will see preferences. Okay. Okay. So in the last session also, like I have shown this like the picture to all of you. Like higher the risk aversion, higher the steepness of your indifference curves. And you can have a look at them. Like if you reduce, then it will be more flatter, and if you increase, it will be more steeper. So now what will be your optimal investment choice in this case? So this is your kind of budget constraint. Those are your indifference curves. And from our choice theory, we know that the optimal allocation will be the one which is like which in the case when your indifference curve is tangent to the budget constraint. So if you draw your and difference curves in this plane also, then you will find one such case where this capital allocation line is tangent to your this budget constraint, and that will be your optimal allocation in this one risky and one risk free asset case. And that we will be like having a look at them again in our like the later like the in portfolio theory in today's discussion only. Okay, this was the case of one risky and one risk free asset. Now let's move to the case where like there is no risk free asset, there is only risky assets are there, only risky assets are there in the available to you. So let's suppose there are two assets, asset 1 and asset 2. Asset 1 has like the expected return of 5%, standard deviation of 20%. Asset 2 has expected return of 10% and standard deviation of 20%. And these two orange dots denote these two particular type of asset in this plane, return and return and standard deviation plane. Okay. Now, what we do, like we like you have, let's suppose you have 100 units of wealth, you give different weights to these two assets, and then you derive like all the possibilities, like possibilities of your portfolio in terms of return and standard deviation. And in that case, like you will find this set. Okay, these the all possible, all points to the right of this blue line, those are the ones which are possible for you to make by mixing these two assets, and we call that the feasible set. This purple horizontal lines, this area is the feasible set area. Okay. Okay, now as we discussed in last live session also, like the any rational investor will only prefer the the combination of only prefer the portfolios with the combination of return and risk of like the with the least return, least risk, and the high return. That's why the leftmost boundary, which is denoted by this blue line, we that is the on that are the only possible portfolios which like the which any rational investor would be looking at, would be interested in. Because how you can see that, like if you draw any horizontal line, okay, then you will see like the any investor would like, if you draw a horizontal line, then you are fixing the expected return, but you are changing the standard deviation. So you, any rational investor would want the least amount of risk. So least amount of risk will be the leftmost point on that horizontal line, and from that like we derive this leftmost boundary which we call the minimum variance set, and which we have denoted by this blue line. Okay, now you see this like the sky blue point, and that is the point where like there is the minimum variance, minimum possible standard deviation is there, and we call like, and this is by giving some weights to these two assets, and which we call the global minimum variance portfolio, and which we have denoted by this sky blue dot. And also any rational investor would only prefer the portfolios which are above this global minimum variance portfolio. Why? Because let's like understand this by drawing a vertical line. So where there are two possible minimum variance portfolios are there. Okay, so if you draw a vertical line at this 15% standard deviation, okay, then there are two possible portfolios on this minimum variance set. One that has like about 6% of 6% of expected rate of return, and another with about 8% of expected rate of return. Okay, so any rational investor would always prefer higher expected return in comparison to lower. So according to that rationality, any investor would prefer only the portfolios which are above this global minimum variance portfolio and on this minimum variance set. So that's why this the which is highlighted by me also, like this area which is above the global minimum variance portfolio and the part of minimum variance set, we call that part the efficient frontier. And this is the only one which an investor would be looking at, and he will be picking one possible combination from this efficient frontier only. Okay, now let's go to that Rice Business School and visualize that from like by changing different variables. So we are looking at two risky assets case. Okay, so this is the case which we are looking at. We had like the 5% and 10% expected returns, standard deviations, and correlations. Okay, so let's first take a look at like how the changing the correlation effects impacts our this eh, minimum variance set. Okay, let's suppose there is no correlation. Then this is the case. If there is minus like negative correlation, then this is the case that remains. Like there will be a portfolio possible where your standard deviation or the various like the risk is like approximately zero and you are like receiving some return. And if you go to that point, then it will show you like asset 1 with 60% and asset 2 with 40%. That will lead to a portfolio which has zero standard deviation. That means that is a kind of risk-free portfolio. And this is the case when the correlation is -1 or the -100%, like perfectly negatively correlated. The opposite of that is like the perfectly correlated. In that case, this minimum variance set becomes a straight line. Okay, so we were looking at the case where like the where your correlation between them was 20%, then this is the shape of minimum variance set. And this is the two risky assets case. And I would recommend you to go to this platform and try to like the see how different variables impacts the shape of this minimum variance set. You can play with like the returns, like if you change the returns then shape changes. If you can play with standard deviations also, how that changes, etc. You will go if you like you can see like how changing these variables like the changes your minimum variance set. Okay. Okay. Okay, please give me 1 minute. I will be right back. Hello.
Yeah, hello, hello.
Yeah, sorry for the disturbance. I am a bit under the weather. So okay, so we have covered this minimum variance set and all. So now what we want to do, like we want to find the optimal allocation for us, like which is the optimal one for me or for any investor, let's say. So So how do we do that? How do we find the optimal risky portfolio in the case of two risky assets or the multiple risky assets also we can see. So if we go to the this Rice Business School platform, and so here we are looking at two risky assets, we can go and look at three risky asset case also. So there are three assets case, and like the leftmost boundary of that, like this blue line, that will be your minimum variance set. Okay. Now one more thing I want to tell you is like we are only like in the two asset case also, like we have only seen the minimum variance set. We are not exceeding these two original assets, correct? Why? Because we in this case we have not allowed like the short selling on these two assets. But if we allow that, then what will be the shape? Like if we allow the short sales, then like like we can, then this minimum variance set can exceed these original assets, asset 1 and asset 2, then we can exceed if we allow short selling on these two assets. Okay.
So
Okay.
excess means this is stretching that curve beyond that orange point.
Yes, like if you go and look at like any point between like the original one, if you look at like, if you like the take your cursor to any point on this blue line, okay, here if you see like it says asset 1 21%, asset 2 79%, correct? If you go to any other point, it will be like under 100% for both of them. So in that case you are investing a like the less than 100% in both the assets. Okay. Now
Mm.
in short sales, what we mean, like you can invest more than more than of your wealth on any one of the assets. So if you see like any point between these two orange dots, that will be like there will be no short selling. But if you go away from that, so for example at this point in asset 1 you are investing -8%, and in asset 2 you are investing 108%. What this means, like you are borrowing 8% of your wealth in on account of asset 1, and you are investing that borrowed amount in asset 2. That, in other words, you are sorting asset 1 with 8% of your wealth, and you are investing that borrowed amount by sorting in the asset 2. Similarly, that you can look at like here also, like in asset 1 you are investing 124%, in asset 2 you are investing -24%. That means you are sorting asset 2 with 24% of your wealth. That means you are borrowing 24% of your wealth with asset 2, sorting asset 2 and investing that extra amount in asset 1 with the original wealth of yours. Okay. Is there any doubt? We discussed short selling like one of in one of our previous session, and I will be taking a brief like the discussion today also. Okay. Now, like once we have this available to us, this minimum variance rate available to us, and as I discussed, like we are a rational investor will only be interested in the part which is above this global minimum variance set, correct? So we are only investing interested in the upper half, like above this point part of any rational investor would be interested in that. And I want to find out like which portfolio or the which combination of asset 1 and asset 2 is the one which I would be preferring according to my preferences. Okay. So let's do that exercise. And okay, so I want to find the optimal risky portfolio, and which will be that? That will be the one which gives me the highest Sharpe ratio. Okay, and how do we measure Sharpe ratio? Sharpe ratio is the slope of capital allocation line. Correct. Why maximum Sharpe ratio? As I discussed previously also, Sharpe ratio is the measure of the reward against volatility. So I want a portfolio which is the highest reward against the volatility. Volatility is a measure of risk and reward is the measure of return. So I want more return in for a particular amount, like the one which gives me the maximum return on account of the same amount of risk. Correct. So that's why we are maximizing Sharpe ratio given this. So and Sharpe ratio is the capital allocation rate. So let's suppose if 2% is the risk free rate, and there are, this is the minimum variance rate, then I can draw multiple lines from starting from this risk free rate, and I will be interested in the line which is like just tangent to this minimum variance rate, like this. And then the tangency point, that blue dot, that is the optimal risky portfolio for me. Okay. Now one interesting thing which you should observe, that when when we are deriving this optimal risky portfolio, there is no discussion of preferences. Like, that means like any individual's preferences are not impacting this optimal risky portfolio. Means the portfolio which is like the console, like which is like the which is made by combining only risky assets only. Okay. This optimal risky portfolio does not depend on individuals preferences. That means it will be same for all individuals. And this is the basic principle of mutual fund industry also, that they, what they do, they combine the funds of all the many individuals, and then they invest according to this strategy, like which maximizes the Sharpe ratio. And let's visualize this in our Rise Business School platform also. So let's go to this tendency portfolio case. So there are three assets. There is risk-free rate, and this is the case. Like, this is the same picture which I am showing in the slides also. Here also, like, you can like play with this. So if you change the risk-free rate to 4%, let's suppose, then this line becomes flatter and flatter. Okay, let's keep this same at 2%. You can change the correlation. Let's suppose there is no correlation between all the asset. Okay, this is 0, this is 0, and this is also 0. So if all them are 0, then this is the case changes. So what I would recommend to all of you, like, you go to this Rise Business School platform, you play with these numbers. Like, if you change the returns of the asset one to 15%, then this minimum variance rate changes, and this, like, you can see like this is more steeper. That means the Sharpe ratio is higher, and you are having more reward against your volatility. Okay, so in this way you can find your tendency portfolio. And in the lectures also, like, we discuss the method, like how to mathematically, how can you derive the, how can you find the weights for these different assets in order to find your optimal skip portfolio. In that case, what you do, you maximize your Sharpe ratio, and your parameters are your weights on these assets, and subject to different, like the sum of weights should be 1. and 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 also there is one more condition, like, okay, that I am not covering. I am just taking like the you are your like the your basic condition is like, you want to maximize your Sharpe ratio given all the conditions. That's it. And you will find this blue dot is your optimal risky portfolio, and this is same for all the individuals. Okay. Now, like the here, like, from all the risky assets, you can find this optimal risky portfolio, this blue dot. Okay. So in the market, what is there? Like, in the market, all the shares are which are there every individual has access to all of them, correct? So that's why in our first week's content, there we discuss two types of risk. One is the systemic and another is idiosyncratic. And we had like a lot of doubts. That's why we call that idiosyncratic risk, because any individual who wants to invest and he has all the possible assets available to him, so his optimal portfolio would be same to another investor if he has all the information available to him also. Okay, that's why any change in a particular particular companies, like the numbers, or any changes in particular companies, like the share prices or any board member changes, etc., etc., that will not impact this optimal risky portfolio. That was the meaning of idiosyncratic risk, because that change in a particular type of. So in the question in our week one's GA, there the from the portfolio we means like the optimal portfolio that any rational investor would build from this available information. Okay, you find that like the reasonable explanation for that question's explanation. Sorry. So now, like, once we have found this optimal risky portfolio, now what you want to do, like, you have this optimal risky portfolio that is coming from like the combining risky assets. Another one is your risk-free asset, and we discussed like the in the start of our today's session, like if there is one risky and one risk-free asset, then risky asset is this optimal risky portfolio, risk-free is this one. Then according to your preferences, that is denoted by this indifference curve, that is this blue dotted line, and this indifference curve is tangent to this capital allocation line, which is there from tendency portfolio or the optimal risky portfolio, where this is tangent, that this star point, then this star point is your optimal capital allocation. Okay, so this is the whole process of the portfolio theory, and let me summarize this whole process. What we do, like, there are three main steps. First, you find the efficient frontier. Okay, you identify all the risk return combinations available from the set of risky assets. So let's suppose risky assets means all the assets which are there available in the market apart from the risk free. Risk free means mainly the treasury bills. Okay, from that you build your efficient frontier. Then what you do, you find the optimal risky portfolio. Okay, what that means, like you identify the optimal like the portfolio on that efficient frontier which has the highest Sharpe ratio. Okay, that means you are finding the capital allocation line with the steepest slope. So optimal portfolio of the risky assets by finding the portfolio weights that results in the steepest capital allocation line. That means you are maximizing the Sharpe ratio. Once you find this optimal risky portfolio, then you do the capital allocation that you do according to your preferences. Okay, you choose an appropriate complete portfolio by mixing risk-free asset with the optimal risky portfolio according to your preferences or the utility function. That means like the point at which your indifference curve is tangent to this capital allocation line, which is the steepest, like the which is combining this risk-free asset and the optimal risky portfolio. So these are the three main steps which we follow to find the optimal portfolio. Is that clear to you? Like,
Yes, sir. How to calculate that is clear, but I just, if you can go back to the first slide, I have just one question.
yes.
Yes. when you are basically calculating the expectation of the reward for the combination for the
Yes,
risks and risk free, for the risky asset, you are taking the expectation of RP, that is the risky asset reward. But
yes,
while calculating the risk free award, you are just simply put it RF, you are
because
not.
that is same, because risk free rate is same. They like that is there is no variation in that. Correct. So
So
expectation
since
of
the
that would be
variation
this.
is zero, that is the
Yes,
expectation of the RF is equal to itself RF.
yes, yes. The
Okay,
variation
just
is
mhm.
so in the probability theory, like the if any variable is fixed, like the that has fixed value, then its expectation is that only.
Yes. I got it. I got it. I just cross checking that and go
Yeah.
to the second slide.
Yes.
Now go to the one more. Next, yeah. Here, sir, in the indifference curve,
Yes.
when you are putting the indifference curve and the indifference curve when tangent to this straight line, this straight line is the maximum Sharpe ratio line, right?
Yes.
And what is that intersection point we call?
We call this like the optimal allocation, optimal capital allocation. So you are essentially looking at this diagram. So this blue dot, that is your optimal risky portfolio. This
There is two.
star point,
Yeah.
that is your optimal capital allocation or your optimal overall portfolio in which you have a mix of your risky assets and risk-free asset. Okay. This blue dot is the mix of only risky assets, and which are like we are having the case of three risky assets. These three orange dots define those three risky assets. Okay, I can show you this in our like this rice business school case also. So for example,
No, I am going there. So just to go back to that slide.
yeah, yes, tell me.
Now, this utility curve where this three risky asset has the single curve, na? But it is not touching that curve.
Sorry.
That three orange point is not on
No,
the curve.
yeah, that is not required. So that is only in the case of two asset. When you have two assets, then this will be like touching that. But when you have more than two assets, then your minimum variance set will be the one which is not required to go through the all the original assets.
Oh, then we will fit the
Yes.
best curve over there.
Yes. So if you like, let me show you here also. Like if you go to three risky assets case, okay, simply, okay. Here if you see this set, so this three assets case, this minimum variance set will be the leftmost part of these blue dots. So if you see like it is not going through this red dot, this asset two, it is not going through that. Correct. So if you change the variables, and then you will be seeing like yes, it will not go through others also. Like it will, if you draw that again to like the you if you allow sorting also, then like you will see like it will not go through this asset one also. Asset two and asset three, it will not go through that. It will only go through this one. So it is not necessary that this your minimum variance set pass through the original asset. It will be the leftmost part of the all the feasible assets which are available to you.
Okay, got it, sir.
And this tangency should be with this capital allocation line, not this minimum variance set. Okay.
Hmm.
So if you have a look at this, like first what we do, first we define that efficient frontier, then we find the capital allocation line that is tangent to this efficient frontier. That means we are finding the optimal risky portfolio. And in later case, once we find the optimal risky portfolio, then we have a fixed capital allocation line. Then we draw our indifference curves and find the optimal capital allocation, which is the one where this capital allocation line, the final one, that is tangent to your indifference curve. So if you go to Rice Business School platform, there,
Is it possible, sir, that when I am basically finding the optimal capital allocation point, that star point with the intersection between your the Sharpe ratio line and the indifference curve. So
yes,
different indifference curve can touch the different point of this straight line,
no,
right? Huh?
the indifference curve has a beautiful property that they do not cross each other. Okay,
Is that
indifference,
is the indifference curve is parallel to each other?
yes, that comes under choice theory, like we discussed during the choice theory case also. Like indifference curves do not cross each other, because if they cross, so I will explain you. Like if they cross, then what does that mean? Like that means like at this point there are two possible utility values, and that is not possible. Indifference curve is the curve at which individual has the same utility. Like on these all these blue dots, that individual has same utility, and by like in this combination of return and risk, individual is having same utility. If they cross, that means like at that combination of return and the risk, individual is having two value of utility. That is not possible. That's why this is the property of indifference curves. They do not cross each other. They are parallel to each other. That's why there will not be two tangency.
Mm.
Like there will be two points where
So
this
out
is
of
tangent.
that many indifference curve set, only one curve I will find which is having a tangent point.
Yes, you can have multiple cases when this line is like the changing. So this is the case where like the sorry, this is the case where like only one risk free rate is there. So there is a there, like I think there is one thing like the optimal capital allocation with different rates. That means there is one rate where like the, so if you see like one is the borrowing rate, one is saving rate, which we discussed earlier also, correct? So there are two, like this first one is the allocation tendency portfolio at the saving rate, and there will be a tendency portfolio at the borrowing rate. Okay, there are two different optimal portfolios, and according to that, you will have two different, like the, like there will be a kink in your capital allocation line, and in that case there is a possibility that there are two possible tendency points according, like the two different indifference curves, those are touching at different points. That is possible. But if we are having only single rate, then no, there will be only one tendency point. And why? Because these indifference curves are parallel to each other.
Okay.
Okay.
Hmm.
So this was our discussion of portfolio theory, and all the mathematical part is covered by professor only. And if you have any doubt regarding that, like the derivation which is done, and many examples are covered in our video lectures, and I will try to cover one in our next session, which is for the division of quiz 2. There I will be covering a full, like the one exam. I will be covering all the formulas and mathematical part with one example, and I will be following like these three steps. I will be following to find the optimal portfolio.
Okay. So what kind of question means numerical question we can expect from this quiz?
Yes, numerical and some like the theory part, like what I would recommend you to like have a look at the previous terms quiz, and most of the like the similar pattern we will be following for the quizzes. and we will like we can change the pattern for the final exam a little bit, but the four quizzes we have a fixed pattern, like we have 25 questions which are MCQ, and that will be the pattern for the second quiz also.
Okay.
Okay, there was a brief discussion of the risk pooling and risk sharing. And risk pooling and risk sharing means like you include more of risky assets in your portfolio in order to reduce the overall amount of your risk. Okay. Risk pooling means like you add uncorrelated assets to your portfolio to reduce risk. What you do, you add another risky assets with the funds from the pool of risk-free asset. So let's suppose at the start you are investing for like the 60% in risk-free asset and 40% in risky asset. Now there is one more, like the one more risky assets that comes to you. Then what you do, like you invest 40% from risk-free assets funds to the risky assets. And in this case, like you will look like the Sharpe ratio increases, but standard deviation also increases, and in that case there is no much benefit. Another case is risk sharing. In that case, what you do, you invest the funds which are given to the risky part, only that you diversify that to the other risky assets. And in that case you see like yes, there is a like the increase in Sharpe ratio. Okay. And this is the like these like this concept is useful for insurance companies, and they utilize these two concepts in order to maintain their risk. Like these insurance companies, to maintain their risk, they utilize these two concepts. Okay, now like as I discussed, like I will be discussing a little bit about like the short selling. So what do we mean by short selling? Like short selling is a strategy in which investors profit by decline in the price. So let's suppose you observe, you do your analysis, and you find that yes, ITC company shares are going to, ITC shares price is going to go down. Okay, then what you, how can you like the gain from this insight? For that, like what you do, like you short on ITC assets. So sorting means you are deriving profit from decline in price of a particular asset. So what are the different steps? You first you borrow the asset. Okay. From whom you borrow? You generally borrow from the brokers. Brokers means the individuals you who facilitate this buying and selling of assets. Okay. You go to one broker, you borrow the asset, and you sell this borrowed asset to any individual who in the market, who is there in the market and wants to buy. So you went to the broker, you borrowed the ITC shares. Let's suppose you borrowed 100 shares. You sold those 100 shares of ITC to an individual. Okay. Then you wait for the price to decline. Let's suppose current price was 400, and after some time it goes down to 350. Okay. Then what you do, you go to the market, you buy that those 100 shares at 350. Okay. Then you return these assets, like these 100 shares, back to the broker, and you gain like you gain or you make profit with the difference, that price difference. Correct. Like this is the full process of the short selling. So let's suppose like you want to exercise the short selling of 100 units of ABC INC shares, and which are trading at 500 rupees today. So in the first step, like you borrowed 100 shares and you sold at the 500 rupees. So you you received 50,000 rupees, correct? After some time, price went down to 450, and you at that price you purchased 100 shares, so you purchased them in the 45,000 rupees. Okay, this is the total cost which incurred to you. So the profit which you received is the difference between that. So you received 50,000, you gave the cost to you is 45,000, so the difference is 5,000, and that is your profit. Okay, in this way, like we calculate the returns or the profit in the case of short selling. So I have given you the link to I have given you the link to the Rice Business School platform, and I, as professor, also recommend, and I also recommend you to go there and try to play with different variables, different parameters, and look at like how that minimum variance rate or the optimal risk portfolio or the optimal capital allocation that is changing by changes in like risk return or the correlation values. Like you should have a look, and that will give you a better insights like how this portfolio theory works. So
So
the
this PDF is uploaded.
yeah, PDF I will be sharing with POD team today, and they will upload it under like the live session notes. There is a drive for live session notes, and they will be uploading it under that only.
Oh,
Okay, so I have not covered this optimal risky portfolio thing which we cover in the Excel, but I will give you an overview and I will be sharing this Excel file with you. Okay, so in this Excel file, what we have, like I have what I have done, like I have like the got the from the Yahoo Finance, I have got the prices for different assets which I have put there for 5 years. I think I have taken from 30th August 2019 to 30th August 2024. Yes, for 5 years I have taken prices for TCS and HDFC Bank. Okay, from these prices, what I have done, I have calculated the returns. That is nothing but like the price difference divided by the previous price, and this is the formula. You can have a look. You can check that also. So what I do, like first I calculate the returns for all the days. From those returns, what we do, we compute the mean. So this is the mean return for TCS, mean or the expected return. Both are the same thing, correct? So this is the expected return. This is the standard deviation. This is the formula STDEV dot P is the formula for standard deviation. So we calculate the expected return, we calculate the standard deviation of the returns, we calculate the covariance and the risk-free rate. Risk-free rate, let's suppose the 5% is the annual risk-free rate. So we have to convert that into daily risk-free rate, and for that what we do, like we simply divide it by 252, because in a year there are generally around 250 or 252 trading days or the working days, because on the weekends trading is not allowed, exchanges are closed on those days. Okay, now what we do, like we have a look at 10 or 12 different possible combination of weights. So for example, the first case is one where you are investing all of your wealth, 100% of your wealth in TCS and zero in HDFC, and we change these weights like 90, 80, and we like these are 11 points. So if you are investing this much amount in these two ones, then what is, if this is the portfolio, then what is your portfolio's expected return? For that, what we have done, so weight of TCS times expected return of TCS plus weight of HDFC times expected return of HDFC. So using this formula, we have calculated the portfolio return. And using the formula for the standard deviation of the portfolio, and from that we calculate the standard deviation of the portfolio. Okay, now we have these 11 points, and what we have done, like we plot them. So we have expected return, we have standard deviation. If we plot them, then we look at like then this we find we get this shape. And if you see, like this is the similar shape which we have seen in the Rice Business School platform. Like this is the shape of minimum variance set. Okay, I have done the same thing for the three stocks case, like where I have included ITC also. We have calculated the covariances. We have multiple points because there are multiple possibilities, correct? There are more portfolios, and if you plot all these portfolio return and standard deviation, then you will find like these blue dots, they build a similar shape, and which is the like the efficient frontier, or what we call the minimum variance set. Like this is the minimum variance set, the uppermost point, like the points which are above the global minimum variance portfolio, above that we call them efficient frontier. Okay, so I will be sharing this file with all of you. And the third one is the five stocks case, where what we do, so we take five stocks, okay, we do the same analysis, we calculate these summary statistics, and then like if time permits later in some week, I will demonstrate this. Like here what we do, like we use the solver which comes with Microsoft Excel. We use that and we try to find the optimal like the weights for optimal weights for these five stocks according to given like the how in the way, like what we do essentially do, we just simply maximize this Sharp ratio given this expected return and risk. Then we can find like this gives me these yellow colored cells are the optimal weights for these five different shares. So if time permits, then later in some week I will be like giving you a brief overview of this, like this method. How can you solve for optimal risky portfolios in Excel? We will be doing that. Okay.
Okay.
Yeah. If you have any other doubts, please let me know. Okay, we can cover that.
No, you just stop the public string and can you just share that site?
Sure, sure.